Rent is not throwing money away, and buying a house is not the ultimate financial cheat code. We're told homeownership is the safest path to wealth. The problem is that advice ignores three invisible variables that quietly drain normal people. By the end of this, I will show you how a lifelong renter can actually end up much wealthier than a homeowner. Everyone knows the standard American script. You rent in your 20s, you save up a down payment, and you buy a house. If you do not buy, you are just paying your landlord's mortgage. It makes perfect sense on paper. You get a tangible asset, a permanent roof over your head, and a forced savings account. But I noticed something looking at the actual numbers people pay over 30 years. The math we are taught leaves out half the equation. It assumes everything goes perfectly. It assumes the stock market does not exist. Let us look at a real example with real money. Say you want to buy a $400,000 house. You put down 20% to avoid extra fees. That's $80,000 cash. You get a 30-year fixed mortgage at a fairly standard 7% interest rate. Your principal and interest payment is about $2,100 a month. Now, you might be thinking, that's not much worse than rent in my city, and I get to keep the house at the end. But here's the first trap. That $2,100 is just the minimum you have to pay the bank so they don't foreclose on you. It completely ignores taxes, insurance, and maintenance. Property taxes average around 1.5% in a lot of areas. That's $6,000 a year, or $500 a month. Homeowners insurance is easily another $150 a month. Then there's maintenance, which is the silent killer of middle-class wealth. A conservative estimate for home maintenance is 1% of the property value per year. That's another $4,000 annually. Suddenly, your monthly cost is not $2,100, it's closer to $3,100. And over 30 years, you're going to pay the bank over $460,000 just in interest. You pay more in interest than the house originally cost. This brings us to the renter. Let us say you decide to rent a similar place for $2,500 a month. You take that $80,000 down payment and you put it in a broad S&P 500 index fund. You also take the $600 difference between the true cost of owning and your rent, and you invest that every single month. What happens to that money usually breaks people's brains, and we'll look at the final total in a minute. But first, we need to talk about the physical reality of owning a piece of property. There is a specific emotional trap that catches almost every new home buyer around year 3, and it completely wipes out their future returns. When you own a house, your weekend is no longer just yours. It belongs to the lawn, the leaky roof, and the dying water heater. If you lose your job, that $3,100 payment doesn't care. It creates a low-level anxiety that dictates your life choices. You cannot easily take a pay cut to do work you actually care about. You cannot easily relocate for a better opportunity. You are anchored to a very expensive piece of dirt. When you rent, the maximum you'll pay each month is your rent. When you own, your mortgage is the minimum you'll pay. That emotional trap I mentioned earlier? It's the house lifestyle creep. It usually hits right around year 3. You start noticing the kitchen cabinets look dated, the backyard needs a deck, the bathrooms need new tile. You start sinking tens of thousands of dollars into renovations that don't actually increase the home's value dollar for dollar. That's money that never makes it into your retirement account. Now, you might be thinking, but rents go up every year, while a fixed mortgage stays exactly the same. That is absolutely true, but remember those invisible costs we talked about? Property taxes go up, insurance premiums skyrocket, the cost of labor and materials to fix your house goes up with inflation. Your loan payment is fixed, but your actual cost of homeownership is entirely vulnerable to inflation. Meanwhile, the renter's money is working quietly in the background, compounding without needing a new roof. Let's go back to our renter and close the loop on that math. They invested the initial $80,000. They added $600 a month. We'll assume a historically normal 7% inflation-adjusted return over 30 years. After 30 decades, that investment portfolio would be worth over $1.3 million in today's purchasing power. That money is liquid, it's cash. You can sell fractions of it with a tap on your phone to buy groceries, pay for health insurance, or take 6 months off work to be with your kids. The homeowner has a paid-off house. Maybe it appreciated to $1 million over that same time. But to access that wealth, they have to sell the house, pay broker fees, and move. Or they have to take out a loan against the house and go right back into debt. The homeowner is asset-rich, but cash-poor. I'm not saying you should never buy a house. I'm saying you need to separate the idea of housing from the idea of investing. A house is a lifestyle choice. It's a place to paint the walls, adopt a dog, and build a community. It's a very expensive, highly concentrated, illiquid lifestyle choice. If you want to buy, you should, but do it because you want roots, not because you think it's the only way to avoid being broke at 60. If you decide to rent, you're not failing at life. You're just choosing flexibility and liquidity over drywall and property lines. The trick is you actually have to invest the difference. You can't rent, spend the down payment on an expensive truck, blow the monthly savings on takeout, and expect the math to work in your favor. The math only rewards discipline. The solution here is simple, and you don't need $80,000 to start. If you're renting right now, forget about the massive down payment. Just try to find an extra $100 a month. Put it in a low-cost index fund. Let it sit there and watch how it behaves. That 100 becomes 1,000. The 1,000 starts generating its own tiny returns. You'll start to feel a subtle shift in your daily life. It creates a tiny buffer against job anxiety. When your car breaks down, you don't have to panic. Then you scale it. You increase that investment to $200 a month, then $500. As your income grows, you keep your rent stable and push the extra cash into the market. You're building wealth exactly the same way a homeowner builds equity, just without the property taxes. Rent is not throwing money away. It's buying you time, flexibility, and the capital to invest in businesses that actually produce cash. Next time someone tells you buying is the only way to build wealth, ask them if they've actually run the numbers on what a house truly costs. Have you looked at your own living expenses lately and asked where your money is really going? If you found this helpful, stick around and subscribe. We look at the reality of money here every week.